With everything going on in the world, supply chains breaking, alliances shifting, the one question every investor has is, where is my money actually safe? Today, we're going to dig into that, and we're going to challenge some of the most basic financial advice you've ever heard.
Yeah, you heard that right. This probably flies in the face of everything you've ever been taught. The idea that diversification, the absolute cornerstone of modern investing, could be dangerous? That's a huge claim. But as you're about to see, just blindly following the old rules without really understanding their limits, well, that's a massive risk all on its own.
For years, we've had it drilled into our heads. Don't put all your eggs in one basket. And that's the heart of diversification, right? It's supposed to be this perfect safety net. But here's the question. What if that net is only designed to catch a few falling eggs, but not the entire basket when it comes crashing down? That's the delusion we need to talk about. Okay, so to really get this, you have to understand the two different kinds of risk. Now, diversification is fantastic, absolutely brilliant, at protecting you from what's called non-systemic risk. That's when one egg, like a single company or one stock, goes bad. But it does almost nothing to protect you from systemic risk, and that's when the whole basket, the entire system, is in freefall.
This analogy just nails it perfectly. A flu shot is great for preventing the flu, obviously, but you wouldn't bet your life on it to protect you from everything else, would you? Well, thinking your diversified 401k makes you totally bulletproof is kind of the same thing. It's like thinking that flu shot makes you invincible to much bigger, much scarier dangers that could be lurking under the surface.
So it's time we get properly introduced to the main villain of our story today, systemic risk. This is the big one. This is the danger that diversification doesn't just fail to protect you from, it can actually make you more exposed to it. To put it really simply, systemic risk is the danger that the whole financial system just breaks. It's not about one bad company failing. It's about the entire interconnected web becoming so fragile it collapses. So think about it. If your portfolio is diversified across, say, the S&P 500, you are, by definition, 100% exposed to the health of that entire system. And this isn't some abstract academic idea. Not at all. When real systemic fear grabs hold of the market, like it did during the European debt crisis or back in the 2008 meltdown, everything goes down together. In a panic, the market doesn't care which of your stocks are good companies with solid fundamentals. It just sells everything. This is probably the clearest way to think about it. If you're diversified across the market, you just own a bunch of different cabins on the exact same ship. And if that ship hits an iceberg, who cares if your cabin has a better view? It's completely pointless. The whole boat is going down. So why are we having this conversation right now? What's the big deal? Well, it's because there are several massive global forces that are actively pumping up systemic risk as we speak. They're pouring gasoline on a fire that's been smoldering for a long, long time. We're going to focus on three of the biggest drivers here. First up, absolutely staggering levels of government debt around the world. Second, something called currency devaluation, which happens through policies like quantitative easing. And third, well, just look around. Rising geopolitical instability that's threatening the very systems we've depended on for decades. Let's quickly break down this quantitative easing thing, or QE. It sounds complex, but it's not. In a nutshell, governments rack up a ton of debt. Then, central banks essentially print new money out of thin air to buy that debt. This floods the economy with cash, but there aren't any new goods or services to go with it. So what happens? The value of every single dollar or euro or yen you have in your pocket goes down. That's what we call purchasing power risk. Okay, I know. That was a lot of bad news. But understanding the problem is always the first step to finding the solution. So, if the whole traditional financial system is the storm, where do we find shelter? Let's start mapping out some of these potential safe havens. We can basically sort these potential havens into two big categories, which makes it pretty easy to remember. On one hand, you've got hard assets. We're talking real, tangible things. And on the other hand, you have protective strategies. These are more about making agile financial moves that can actually do well in the chaos. So first, hard assets, literally stuff you can touch. Physical gold has been a store of value for, thousands of years? Commodities like oil and food are things we will always need. And of course, real estate has its own built-in value. Now, the common thread here is so important. None of these are institutions. A bar of gold cannot go bankrupt. The other category is all about protective strategies. This is about being financially nimble. It could mean rotating into defensive sectors like healthcare and utilities.
things people need no matter what the economy is doing. Or, for more advanced folks, it could mean looking into assets that are actually designed to go up when the market goes down, or even directly betting against the market. Now, these definitely require more research, but they're powerful tools for navigating volatility.
All right, as we start to wrap this up, the goal here isn't to hand you a list of stock tips. The real goal is to give you a totally new way to think about risk and safety. It's about shifting your mindset from being passive to being active. You see, a conventional portfolio is basically built on hope. You just hope that things will work out in the long run. But in a world full of systemic risk, hope is not a strategy. Real safety, real security, comes from understanding these deep risks and then taking deliberate steps to gain some control, to move your assets to places of real, durable strength.
And that brings us to one final, critical question that I want you to ask yourself. When you look at your own investments, your own savings, through this lens of systemic risk, what do you see? Do you see a fortress built on solid ground that can actually handle a storm? Or do you see a house of cards just waiting for the next strong gust of wind? Really think about it.